Hi, good afternoon. Great to have you aboard. Let me go out and take a look at option pricing. This is a topic that we look at every couple of weeks, and I know there are many new people that come on, and heck, even those of us that have traded for years in the market, this is really an important concept to understand. Is how to price risk on an option. Okay, so I'm going to use Apple. And Apple is a stock that at the present we have a put option on. And we'll go take a look at that put. The put's up a little bit, and we got in back here after the not analyst day, but the more technical day here for Apple. And it's continued lower. It's in a vibe bear signal, been a little choppy up and down. How much do we stand to risk? Well, we have our stop up here at 450. Okay, the high price from that analyst day. And so we have our stop there. What do we stand to lose? Well, let's go take a look at the option chain. Okay. And here's Apple, and you can see it brings up the position down here. But we bought the July. Okay. We bought the July 450 puts. Okay. Now they've gone deeper into the money since we got them, and this is a kind of a more in the money style of trade. But these options are going for about $25. Okay. So how much do we stand to risk for time decay? How much do we stand to lose if the price goes against us? How can we figure all that out? The real easy way to estimate it is to just say, look, here's the 450 strike, here's the 445 strike. If Apple goes down $5, or goes up $5, my put options are going to go from $25 down to around $21.50. So I'll lose about $3.50. Okay, let's say our option goes $20 against us. Well, we take $20 different on the strike price, so $4.50 down to $4.30. So in theory, our $25 option will be worth about $13. Okay. You can kind of get a real rough estimate. Now that doesn't take into account implied volatility, doesn't take into account time decay. We can be more exacting in our measure by going and looking here at the website cboe.com. Okay, cboe.com. And just coming up here to tools and down to option calculator. Tools and option calculator. We can come in, put our symbol Apple in, and hit go. And it'll bring up our data. Now, it'll always bring up the data from the prior day. This doesn't update in real time. So let me go put in the data here for today. Apple stock is trading what, at 430.88? Okay. So let's put 430.88. We're in the July 450 strike, correct? Okay, so we'll change our strike up to 450. And let's go to July. Now you have to be careful. Some of these are the weekly options. So we're looking for the third Friday in July. Okay, third Friday in July, which I believe is the 20th. Let me just double check for us. Yep. Okay. 19th. So their expiration here is the 20th. So that gives us 36 days. We'll hit calculate. And they calculate the put option to be $25.15, which is about what we were seeing, right? Okay, about what we were seeing. Now, sometimes the option won't be about what we're seeing. Okay, so what's different? What's wrong? Did you put the numbers in wrong? Well, a lot of times it's caused by a change in volatility. Let me just show you what happens to those put options on Apple if the implied volatility goes to 30. Our put options go from 25.15 up to 27.80. That's a big difference, right? If our implied volatility falls down to 20, our $27 option falls down to 23, even though time, price have all stayed the same. Okay. This is one of the reasons why put options are a little bit easier to trade. Okay, because when the stock goes down, the implied volatility goes up. And so that kind of helps build your gains. When you're trading with call options, Well, yeah, the price of the stock goes up, but your call options are drugged down a little bit because the implied volatility falls. Okay. Now, obviously, price direction on the stock matters the most, but there is this implied volatility factor. Okay, so I forget what that was. 23. Yeah, it was probably what 24 something. Okay, close enough. 24, 30. I'll just put in. Okay, close enough. Okay. So now, how much do we stand to lose for time? Well, let's put our days to expiration. Let's say this weekend we're looking to hold it. So we'll lose, let's say, 3 days. Our option that's 25 is going to go to 24.50. So we're going to lose about 50 cents time decay. Okay. Now, is that a big deal? Well, percentage-wise, that's not a big deal here at all. From a percentage standpoint, 50 cents on a $25 option is negligible. Okay, so it's nothing that I would even hesitate with because, look, the price of the stock moves by 50 cents every minute, so that's going to offset that very easily. But what I can also do is say, well, let's say, the stock goes and hits my stop. Let's say it goes up to 450 and hits my stop. My $25 option now goes down to $13. Okay, we can kind of see how that happens. Now, we estimated $13 when we looked at the chain, but this gives you more of an exact feel for how things are changing. Now, on here, we have what are called the delta, gamma, theta, vega, and rho. These are referred to as the option Greeks, okay? And you can click on the question mark, and it'll tell you what each one of these are, okay? And then you can put the definition into Google and see if you can get a translator, right? Delta, the amount the option price has changed for a corresponding 1 point change in the price of the underlying security. Okay, what does it mean? Well, every dollar that the price of Apple goes down, okay, we're going to gain about 48 cents on our put options. Gamma talks about the rate of change of the delta. Theta talks about time decay. So we're basically losing about 20 cents a day. Okay. Sorry, I hit that button and erased it. So about 20 cents a day. Okay. Vega deals with volatility and Rho deals with interest rates. Okay, which for most options we don't have to deal with. Okay, so all in all here, this is how we can kind of calculate. You can estimate it, or you can bring it into some option calculator like this and get an exact price. You can look at what your option value will be if you're right on the trade. So we're looking for Apple to go down to 410. So we're looking for our put option to be somewhere around $42, $41, $41, $42, somewhere in that region. Okay, that's what we're looking for. All right. Well, any questions on this? Please let us know. Great topic. Great thing to understand and necessary in understanding the reward to risk ratios when it comes to trading options. Take care.